It is March 17th, really late Saturday, or you can call it Sunday morning. And this is the video log that takes $30,000 to $1 million. I didn't get a chance to make a video on Friday, so I'm making this now. I'm going to update you on the account, show you some of the highlight trades from the week. And later we're going to talk about the bull case and the bear case for the US market from my perspective and what my opinion is and what's going to happen. As far as positioning for either one of those cases, you should watch the previous video log where I talk about being net long at all times when it comes to market correlated assets. So first, let's run through the account real quick and see what's happening. We got to record this all-time high while we still have it. All right. So this is the week in review here. It's a very, very positive week. It's a gain of about $2,000 or so, 3.85%. And you know I love to beat the market, and this week I've done that. S&P, or the SPY, is only up for the week 3%. So we beat it by a little bit. All right. Happy with that. 3.85 is good. The main reason, of course, is Apple. Apple gained 9.17% for the week. Very, very, very strong. So that was the main reason, but I have other reasons like, chemical, for example, from the uranium, the whole entire uranium sector did really well. Chemical was up 8.28% for the week. And then we have energy fuels as well, which was up 11.89% for the week, etc. So we've had some gainers that contribute to that. A little bit of losses. My hedge, my SH, which is the S&P 500 short ETF. It travels the inverse of the S&P 500 index, and we had I think the Russian market was actually pretty positive too over the week. Yeah, 3.27, not bad. So we had a lot of good gainers and some negatives, but nothing too special. I've got a few dividends which contributed to the gains as well, and one of the biggest highlights of the week was the Spotify trade. You can see this lovely message that I receive here, which is that these two options have expired. That's very good because I initiated a $75 spread premium collection from a call spread that I did on Spotify, I think on March 15th, and it just expired this Friday, so that's $75 in the bank, or in the account in this case, which is great. I don't have too many options running right now. I'm waiting for my buying power to increase when my collateral returns from the Spotify trade, and I'm going to initiate some more option sales. So I'm waiting for that. Now, these were the highlights. Let's see how Spotify traveled through the week. It was very interesting. It shot up real high, and I was pretty worried. It went from 139 to 147. So I thought, man, maybe for sure we're going to hit 150 and I'll lose all my money. But we didn't. And we fizzled out towards the week with Spotify, which was good. And I got my money, $75, and my collateral, which I'm going to be receiving on Monday, probably. All right, so the big topic now of today is the bull and bear case for the markets. All right, so the U.S. market, what I think is going to happen over the next year or two. And let's start with the bull case. So the bull case is that interest rates are still fairly low when it comes to the Federal Reserve. They're still keeping the interest rates pretty low, and they're promising the markets that they're going to be accommodative and patient with the developments in the economy, and just not really hike them up really too fast in order to crush everything. And so that's point number one. Point number two is a lot of people are thinking that the Trump tax cuts for the corporate world are a one-time event, But I've discussed before in a different video log that it's an ongoing thing, right? Once you can raise the rates back up, but as long as the rates are down, that's gonna free up capital to be reinvested in employees or in research and development and buying back shares or whatever it is. That's not really an investment, but it could be used for many things that eventually either directly or indirectly contribute to the rise in the indexes. So that's point number two, and there's more. Um, Point number three, which is foreign markets. So many investors are looking abroad and they're seeing all this turmoil around the world, like in China or what, pick your emerging market. All right, Russia's not doing too badly, but um, things in Europe aren't going very well, etc. So all these markets are really having a hard time, partly because of the strong dollar and the effect it has on the foreign markets. A lot of foreign market debt is denominated in dollars, so when they have to pay it at a rising dollar and they convert their local currency into dollars, you can see how it's tough to do that. So the big companies, especially, that's how they're funded. So it's very tough for them to thrive in such a rising dollar environment. So whenever the dollar dips, it's a really good opportunity for emerging markets to shoot higher basically right away. So that relationship is well established. But my point here is that since the emerging markets are not doing too well and the rest of the world period is not doing too well, then what ends up happening is all the capital is flooding, right? Because they're easing. All the other central banks are easing. They're throwing, they're lowering their interest rates. They're launching all kinds of quantitative easing type of programs in their own countries and regions, like in Europe and Japan, and a lot of that money is finding its way back to the U.S. So the people who get their hands on that money and borrow against these really low rates, they're reinvesting it for a return in the U.S. markets because the U.S. is strong, the dollar is strong, the structure functions. Everybody trusts the U.S. and their rules and how stable the country is and their economic structure, the way businesses are treated around here, and now with the lower taxes and everything else. And so a lot of the states, even in the U.S., are actually tax havens for foreign investors. So a ton of the percentage of that money that is created basically abroad makes its way to the U.S. markets, which gooses the the markets even further. So that's three reasons, right? Three reasons that I think the markets could go up. Now, the downside, the bear side of the argument, from the way I see it, anyways, everybody has their own reasoning and their own conclusions, but my opinion for the bear side is, well, number one, we've had a pretty extensive bounce off of the lows from the New Year's Eve downturn, the 20% dip or so, and it's been going very, very, very strong, and it tried pulling back. It didn't really sell off too much before it kicked back into gear, the rally from the markets. And from a technical perspective, though, it's hitting levels that it's hit a few times before last year and did not recover from. So it's going to be a really big test for the market. And because we've come so far for so long, since December 24th last year, from it's this rally might be exhausted, at least for the time being. It might be exhausted from a technical perspective. I do think the money is going to come back in, but you know, you got to be ready for anything. So that's why I have some hedges. Um, Other reasons that I think that the market might drop is economic data. So it hasn't been going very well, not just to mention in the rest of the world, but US can also catch contagion from this kind of weak economic activity that's happening abroad, and not just get contagion, but a lot of it is born here at home. Interest rates are quite a bit higher than they were just a couple years ago, and people are starting to have a tougher and tougher time with these interest rates. You know, all the businesses and stuff like that, and interest rate related activity might be already slowing down. It could be. So that's another negative for the market. Um, and there are other negatives, like there are some quote unquote leading indicators, like the transports, for example, the transportation sector. Um, it hasn't been looking too hot, and there are some segments, significant segments of the market are struggling despite the overall rally. But to say the least, the market's going through some change, and that is also another point, right? Because the market's going through change, that breeds uncertainty, which breeds fear, which breeds sell-offs, right? People want to go on the safe side. And there's another reason, and simply because the market is just way too freaking high, right? The Dow is so far above the 2007-8 heights without a really an enormous correction. Yeah, we might not see anything like 2008. You know, markets might not drop 50%, but we've only seen that correction or downturn last winter, and then outside of that, it's just been a few 10% drops, but nothing really major where you can really call it a bear market. So I know that's not really a good argument just because we haven't had a bear market yet. We're bound to have one. That's not a very good argument, but the situation right now is very reminiscent of 98, 99, 2000, where the markets were really overbought for the US. The tech sector, the innovation was just blowing things up out of proportion, and the emerging markets were actually suffering. Right, I remember those days. The dollar was really strong. You know, the metals were really low. Emerging markets were struggling. There was hyperinflation in my own country of Bulgaria, and other countries were experiencing major inflation and economic downturn. So it was kind of crisis mode for a large part of the world, and people were seeking haven in the dollar, and they were beating that up. And then once 2001 happened, and there's some confidence loss in the U.S., then with the weakened dollar, everything started flooding into the emerging markets, and it was just an enormous explosion. Whereas the U.S. kind of, fizzled out a little bit, and then they had to start doing the housing stuff to pump the market back up. But that we're getting a little bit off topic. But my main point is that this time period is very reminiscent. The stage is set exactly the same as that 99, 98, 99, 2000 type of scenario. So just because it's happened in the past before doesn't mean it's going to happen again, but there's precedent, which is the important point. So that's another reason to anticipate a sell-off in the markets, one as big as we had in 2001. Now, those are the sides, the arguments, and some of the points that I have for whether or not we anticipate a bull market or bear market from here. And the way I'm positioned personally, I talked about in the last video, is with your market related investments. That's an important point. With their market related investments, you want to be net long, but maybe not more. Maybe not more than 55%. Let's say, if you're really convinced that things are going to go down, 55% bull is good, 45% bear, or hedge some uncorrelated asset to the market would help. So things that will help you survive a downturn, basically. You could have bonds, gold, whatever, housing. You pick your hedges. So as far as what my percentage is, I'm thinking that I'm leaning more on the small correction with a continuous bull market for the next couple of years. So I think that we've had a really nice run here from December 24th, and there's going to be a correction deeper than the one we just had, more than just a few percent. But I think that the bull is going to continue, and we're going to be a little bit more better than flat on the year. So I don't anticipate anything catastrophic happening this year. And I'm positioning accordingly, but mainly though, I'm just making money off options calls and selling puts and selling calls. So, whoops, shaking the camera a little bit. So I'm going to be sticking to that strategy and try to grow the portfolio in a very what I interpret as intelligent way. You know, many people can disagree on that. So, okay, I think that that's it for today. This is the week chart, 3.85%, all-time high, $53,310.11 at the moment. And this is the all-time chart. It's looking pretty explosive. This is when I kind of started making videos and started taking this account a little bit more seriously. It was unfortunate that we had a downturn right afterwards, but I made it work for me. As you can see, the bounce off of those lows has been significantly more profitable than the downturn was harmful. So that's good. We got to get to 1 million. I'll be doing my best here, trying to identify some option trades. Probably gonna sell some more contracts around Spotify, and I'm looking at making a really large special option trade where I go really aggressively long one stock and really aggressively short the other in the same sector. So stay tuned for that one. If I decide to do it, I'm going to look into it next week. So we'll see. All right. That's the view. And that's it for today. Peace out.